the property, and it's a property that qualifies otherwise under the statute, then the second and third holders would also not have any recourse against you above and beyond the property itself. Mm-hmm. So it's the type of lending that it was originally that can control that. But again, people do things after the fact. They refinance, they add equity lines of credit to their property later, and these are not necessarily going to be non-recourse loans. And mm-hmm. I think a lot of people didn't realize that when so many people were pulling equity out of their properties and sometimes refinancing every year.
Oh yeah, yeah. Okay, well, let's see here. What happened? Well, I think I'm going to let that go for now. What is the tax consequence for a deed of trust sale of a non-recourse debt? So we've got a non-recourse debt now. The simplest one, of course, is now we just got an original mortgage when you bought this property. Now we said also that we can throw even the second and third if it relates to the purchase of the property.
Right, right.
And so now this property, we've got a deed of trust sale action that happens. What happens tax-wise related to that?
Well, in the non-recourse financing area, what happens is the property is deemed to have been sold for the amount of the mortgage. Mm-hmm. So that's important to understand, because if the mortgage was $400,000 but the property is only worth $300,000 when it's foreclosed, then for purposes of calculating tax, it's sold for the amount of the mortgage. Now, there are two types of tax that we're concerned about here. One is capital gain or loss, and the other is this cancellation of debt income. Mm-hmm. So there is no cancellation of debt income in non-recourse mortgage foreclosure by deed of trust sale, because if the property is deemed to be sold for the amount of the mortgage, then the mortgage and the purchase price or the sales price are the same, and there's no debt that was canceled. But the capital gain or loss is calculated on the basis of the difference between the property owner's basis on the property, which is usually what they purchased it for, right, with some adjustments, and the amount of the mortgage. I believe that's correct, yes, right? Yeah. So the capital gain would be the difference between those two numbers, and then whether or not you have tax on that depends on whether, again, it's personal residence and whether it qualifies for the $250,000 exclusion for an individual taxpayer, $500,000 for a married couple. So if it qualifies under that, then you may not have any taxable gain or loss on the transaction either.
And in almost all cases, when you're talking about a purchase money mortgage, the mortgage is going to be for less than what you bought it for, because you usually have put something down, right, for the purchase of the property. So actually there's going to be a loss. Right. It's going to be a non-deductible personal loss.
Right. I'm ssmiling because the mortgage should never be more than than you paid for the property.
But we've seen one or two.
It shouldn't be. But.
So anyway, okay. Well, now, what about the situation of a short sale? So now, instead of having the deed of trust foreclosure type of action, we're having a short sale that's happening. What do we think we got going on there tax-wise?
Yeah, well, this is even more complicated, unfortunately, because a short sale is basically a voluntary transaction between a lender and the borrower. And so the question again is whether this is recourse debt or non-recourse debt. And in the case of recourse debt, it's pretty much the same as a foreclosure, is the way I understand the tax mm-hmm. consequences. Yeah. So you would have the amount realized is going to be the fair market value of the property at the time of the short sale, at the time of the foreclosure. But with a short sale of non-recourse property, non-recourse debt on property, it's more complicated because there is some basis for the conclusion. There's a case out there named Briar Park, which came right. out of the Fifth Circuit, right. and it says that in the case of short sale with non-recourse financing, that the amount realized in the transaction is the amount that was paid in the short sale plus the debt that goes away.
Right, they canceled it.
It's not considered cancellation of debt income. It's considered to be part of the sales transaction.
Right.
And so it's sort of similar to the non-recourse situation with
Foreclosure.
foreclosure.
Yeah.
And the reason that case isn't so definite is because, first of all, it was in the context of commercial property, not residential property. That shouldn't make a big difference. But the note itself in that case was actually a negotiated non-recourse debt. So the bank agreed that it was non-recourse at the time that it was created. And in the context of most of these single-family properties that we're talking about, it's not going to be that. It's not going to show anywhere in the mortgage that it's non-recourse. It's going to be non-recourse because of the anti-deficiency statutes.
Yes.
So there's a lot of confusion. I've read a lot of different opinions, and some people state flat out that in a short sale with non-recourse debt, the tax consequences can be worse than in the case of a foreclosure, because you might end up with some cancellation of debt income in that context. If Briar Park is going to hold as precedent, then maybe that's not the case. So, but I think this is definitely a shady or a gray area of the law. You know, if you're going to negotiate a short sale, you know, you want to make sure that you've talked to somebody about these potential consequences. Because the reason this matters is we have another thing that was recently passed, which was a federal law that was a forgiveness of these deficiencies, or these forgiveness of debt. And again, it's in the context of single-family homes. And basically what the Debt Relief Act said, the 2007 Debt Relief Act said, was that for certain qualified properties, the relief of debt income is not going to be taxed. Okay?
Right. Yeah.
So then you've got to look at your particular property and decide whether you qualify under that. And then the other problem in that area is that California hasn't fully complied with that federal law. It did for a while. The numbers were slightly different. The amounts that they would allow were slightly different. But it was only for the tax years 2007 and 2008.
Right.
So for this year and forward, there is no Debt Relief Act in California.
Right.
And so you might end up with a strange situation where you qualify for this relief under the federal law, but not under California law. So you end up with some California tax in a short sale that you don't have on your federal return.
Right. Okay. So we sort of covered the non-recourse. In a sense, maybe we started backwards. Maybe we should have started with recourse, but we'll talk about recourse now. And then I'm going to hopefully have a couple of minutes again to talk about this federal relief. So what if we have a foreclosure, or we could say actually a trustee sale, because that's actually what they are in California, as we said, for
most of the time.
Most of the time. So what if we have the trustee sale under the deed of trust for a recourse mortgage? Now what is the tax consequence?
All right. Now this can apply, you know, in the context where it's not residential property. It also can apply in the context where you bought a property, but then you refinanced it, or you did other things later,
Right.
and you turned your non-recourse debt into recourse debt.
Right.
And so now the property is foreclosed, and the tax ramifications there are, I believe, that the fair market value of the property at the time of foreclosure is the amount realized for the property.
Right.
And that if the amount of the debt you have exceeds that you're going to have debt relief income to the extent of the difference between the two. So again, you have two types of tax you're worried about: the capital gain or capital loss on the property, and the debt relief income. So for capital gains purposes, you would compare the amount realized or the fair market value to the basis of the taxpayer to calculate gain or loss.
Right.
And then you would look at the difference between the amount realized and the debt to determine if there was debt relief income.
Right.
And then you get into this statute again that we referred to earlier, which is if it's a certain type of qualified debt, it's a single family residence, it could qualify under federal law, at least for the next few years, for avoiding the tax on the debt relief income as well.
Right. Okay.